Welcome to Kaizen Time, part of the Blood, Sweat, and Business podcast, where we provide constant improvement to businesses through timely, actionable financial solutions. Do you want answers to your financial questions? Email us at bsp@kaizencpas.com. I'm your host, Mark Valesky. Now let's get started. Welcome to another episode of Kaizen Time. I am joined by Henry Jorn, a manager here at the firm. Henry, I got a question for you.
What's up?
How would you develop a KPI? Like, just out of the blue, like, you run a business, you have employees. How do you even decide what KPIs to use? And just so we know, KPIs are key performance indicators.
Yeah, so KPI, it's the hot acronym for the last 10 years or so. But yeah, key performance.
AI is now the number one, in case anyone wants to know.
It passed it up.
Yeah.
So KPIs, what really their primary function is, right, is to maybe almost have a more current than a financial statement cadence, which is more like monthly, right? Way of using numbers to drive your business. So when it comes to, creating KPIs, the logic behind it is you kind of in some way, shape or form, right? Like, it is a business. We're here to make money. So in some way, shape or form, you usually have dollars in there somehow.
That makes perfect sense.
And then you got to think about, like, what are the things that your business does or makes that drive those dollars. And honestly, most KPIs fundamentally are not hard to calculate. You really don't want them to be hard to calculate, because then you're going to spend all your time calculating them instead of like trying to draw conclusions from it, right?
And we know complexity is a business killer, right?
So if you look at that formula that they created for a quarterback rating in the NFL, which is like the fourth iteration of it, that is probably not the route you want to go.
So, okay. So tell me, let's say I make tables. Okay.
Sure.
What would be a really good KPI for something like that, or furniture?
You could start as simple as, what did it cost me to make each table?
And that's just bringing in raw materials, right? Like, it cost me this much for the wood, it cost me this much.
You got labor, right? So you got the equipment. So you got you got overhead, or you might hear it called manufacturing overhead, the building and the utilities used to create the table, and et cetera, et cetera. So literally your metric is just all of those costs added together, divided by the number of tables you made.
And that can get really tricky, because what it sounds like is, let's say that to make this table, you need a $10,000 piece of equipment, right? And then you take that $10,000 and divide it up against all the pieces of table that have to go through it. Is that how it works?
It depends on how you want to look at that $10,000. So you could look at it like that was in your investment. So then it becomes depreciation, and then, like, depending on which book of cost accounting you read, it could be included in your direct costs, or it could be an operating cost depreciation. So, some manufacturers will include a component of their total depreciation in direct costs, and becomes part of manufacturing overhead, which I alluded to initially. In the basic concept is simple, but you could make it more complicated if you want to.
The simple would be, this is how much I think it costs me at $1.
But the other way to measure that would be to do it more like a ROI basis, or a payback period. For example, like, how many months or years is it going to take me to cover this machine investment? So those are a couple, like, alternative ways to look at something like, the initial investment to a machine as a KPI. But it's kind of up to what your aim is, I guess. And again, like we don't want to make it complicated. So,
Right.
if month one, it took you, $600 to create a table. And generally speaking, when you talk about those costs that feed into it, you probably don't have a ton of variability in materials costs. Maybe, if you import everything and labor laws change, or you have a volume discount that you can take with your vendor, these are more macroeconomic impacts you can have. It's generally going to be the labor that's going to have the most impact on your day to day, which I know I've talked about this in like 18 other podcasts.
Every single podcast you come in here, you talk about labor cost. Yes.
But if one month it took $600 to make each table and the next month it takes $550, like that's a big win, right? You take that $50 and multiply it across the number of tables you made, and that's the amount of additional money you have in your pocket.
Yeah.
And that kind of that's gross margin, right? When we talk about gross margin, it's also a KPI. You see it on the P&L. It's probably, one of the KPIs you see on generally every single financial statement. People talk about it. It's a simple calculation. It's literally your revenue minus your direct costs. And if you want the percentage, you then divide that by the revenue.
Okay.
So basically that's what you take home. The percentage is the amount you take home for every dollar that you sell. So if you sell $1 worth of thing and you make 50% gross margin, you got 50 cents in your pocket to go pay the operating expenses. So those are kind of like basic type metrics. And what I kind of wanted to do, again, you don't want to have a million KPIs. You don't want to have ones that are super complex to calculate. We talked a little bit about gross profit, and of course, then the other one is net profit. So after your operating expenses, what is the money you came home with? These are very good for like looking back and judging performance, but they don't always, tell like, hey, what's coming down the line.
You the whole story. Yeah.
And right now we're kind of focusing a little bit on financial metrics. So another one that I think a lot of business owners miss, but it's important for several reasons. So current ratio, super simple. It's a balance sheet ratio, which I hate to say this, but a lot of business owners either don't look at the balance sheet or don't completely understand the fundamentals of it. And this isn't meant to be an insult, right? Like I did 4 years of school and another year after my bachelor's, and then I did a year of CPA school, and then I worked for 15 years to understand all these things.
Yeah. Yep.
But the current ratio is literally your current assets divided by your current liabilities. Essentially, the number that you get out of that is how many times can you pay your current liabilities, which is like your AP, any short-term debt that you have, with your current assets, meaning your cash, your receivables, and your inventory. And it's super important. So if you're under 1, that means you can't even cover your current liabilities with your current assets.
And that's what we mean by you can't even pay for
you can't even pay your bills.
Yep.
So the other people that look at this is actually your banker. So if you have a loan out with them, it's possible or likely that this will be a part of the covenant if you have a covenant. But it's something that banks pay a lot of attention to because they're assessing whether or not you're going to be able to pay the loan that you have out with them.
Right, because they need to make money from this, right? With the money that
Sure.
they loan you. And if you're not paying for what you already have, why would they give you more?
Correct. You got it. Exactly. So, the other way I like to use this. So if you have some agenda to do expansion, you definitely want to be well above one, maybe between that 1.5 to 2 range, before you start seriously thinking about expansion. Because otherwise that expansion is going to put you seriously underwater, and you might not be able to get out.
By expansion, are we looking for like a completely separate facility, or are we looking for just, extending your footprint? What does an expansion look like?
So an expansion generally means, and you are right, all of your suggestions are
So it could be
correct.
it. Okay.
It could be anything as big as, purchasing a new business or another business, opening a new facility, to even as small as like purchasing a small piece of equipment that is going to help facilitate, some kind of financial gain, whether it's something that'll spit out the widgets a little more quickly.
Love those widgets. Get a new widget maker.
New widget maker.
Yeah.
Widget maker 5000.
So essentially it's one of those don't put the carriage in front of the horse. Don't go out and start spending something when your KPI is telling you're not in a position to be doing this.
You won't sleep at night. That'll be the result, unless you are insane.
I want to kind of rein this in, Henry. What would you say is the most important and the most valuable KPI to you, if you had just one?
So I am a big proponent of the current ratio, which we were just talking about. Of course, all the financial ones. I do like hybrid operations / financial metrics, which we talked a little bit about with the cost per table. Mm-hmm. Some might even call that like a throughput metric. Basically, what does it cost for you to process something end to end? So I do think all of those are important. I do, particularly with small business owners that, don't have a full like financial staff on hand. And maybe, they get a little confused. They look at the P&L and they're like, hey, my P&L keeps telling me I'm doing great, but I got no money in my pocket.
At the end of the day, they're still sitting at a couple grand.
So one thing that I like to talk about with that is so DSO, and this really pertains not so much to cash businesses, but people that have AR or accounts receivable. So DSO is basically a calculation to come up with the number of days it takes your average customer to pay you. Mm-hmm. And what you kind of want to do is look at that and then look at what your DPO or DEO is, which is how long does it on average take you to pay bills? If there is a mismatch there, which oftentimes there is, right? Because your customer has more leverage on you than your vendor does, or
than you may on
your vendors. Yep. Then that's going to be a significantly driving cause to, having that big discrepancy between your P&L and the cash in your pocket.
Okay.
Where I see this mismanaged a lot is, particularly with small business owners, they're in the corporate world, their AP staff is trained to, pay bills at the due date. Mm-hmm. And if you don't have a corporate AP staff, it is likely that they are paying bills whenever they pay bills.
Yep.
And a lot of times it tends to be, 15 days, 10 days, 20 days less than what the due date is on the bill. And so I will emphasize, like, if you are having this issue, to take a look at, whether it's your bookkeeper that does this work for you. If you have a formal accounting staff, or if we do it for you, because we actually do that service too. Just talk to, whoever that is and make sure like, hey, are we actually paying on the due date and taking advantage of those terms? You also have some out of the box strategies like, if the vendor will take credit card, you could get yourself like another 30-day leash on paying those bills, depending on, of course, when your pay dates are and when the cycle ends. But so a couple little strategies there to help you, close the gap between the AR days outstanding and the AP days outstanding.
As we wrap this up, I have one last question for you, and this is a little bit more fun, I guess I'd say. What do you feel is a KPI that you see and just doesn't matter? Like there's all these really powerful KPIs, but I'm sure there's people measuring certain KPIs that one just like doesn't seem to make any sense from a business standpoint. You ever seen anything like that?
Anytime that I see one that is super hard and complex to calculate.
Please tell me you have at least one example like that you just have in your mind. They're like, this is terrible.
Hey, does this save me on taxes?
Okay.
So that's one question we get a lot. And the way you really you can't look at like what you saved on taxes to
what you spent trying to avoid the taxes.
You got to, how you kind of look at it and how they teach it to you in school is actually you take the purchase and you subtract out the tax savings. And that's how much you're purchasing it for, rather than just looking at the tax savings isolated.
Spent, yeah.
Yes.
Cool. All right. Excellent. Well, thank you so much, Henry.
You betcha.
You've been listening to Kaizen Time, part of the Blood, Sweat, and Business podcast. If you like what you heard, subscribe and leave a 5-star review. This podcast has been brought to you by Kaizen CPAs Plus Advisors, providing advisory and accounting services to help you grow your business. Learn more at kaizencpas.com or email us at bsb@kaizencpas.com.